Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Adam Gower with us. And Adam, it's great to have you. I would just love to hear a little history of how you got to where you are currently and where you grew up.
Well, I am delighted to be on the show. Thanks so much, Bruce. It's a real pleasure. I'm flattered you asked me. All right, so you asked where I grew up. You referred, before we started, you referred to my accent. So I always like to tell people I'm actually from West Texas. Because you would be surprised how many people say, really? You're from West Texas? And then I say, yeah, I'm from Lubbock, Texas. Have you ever been there? And they say no. And so I say, well, this is how we speak in Lubbock. But my wife always kicks me under the table when I do that because whatever, anyway, it's my humor. I'm from Northern England, but I have basically spent my entire adult life in the United States, with the exception of the 1990s that I spent in Tokyo. I learned to speak Japanese, ran a division of Universal Studios. I did all of their real estate development in Asia Pacific. And so I learned to speak Japanese, and I used to give press conferences in Japanese. It was always a lot of fun, negotiate contracts in Japanese. I had a $400 million budget, so I was well regarded. But anyway, that was my time in the 90s. In the 80s, I raised money actually in large part from Japanese investors. You're old enough, Bruce, to remember this.
Oh, yes. Yeah.
And there's a lot of Japanese activity. And so I raised a lot of money for ground-up multifamily developments in Southern California. And when the savings and loan crisis collapsed everything, I lost everything. And when I went to Japan, I was 26. And the year before I left, I on paper was worth millions of dollars. I mean, from nothing to literally millions. In 90s, 80s money, it was worth. It was really a lot of money in those days. Yeah. And it just went poof, and I lost it all. So anyway, that's how I ended up in Japan. And then I came back and I started doing my own development work. And in 2007, I sold out everything right before the GFC, the financial crisis. You know, it's funny, people talk about, I distinctly remember it being called the global financial crisis, but now everybody seems to like to call it the great financial crisis. Either way, the GFC. Yeah. And subsequently, not having any legacy problems, I was brought in. You probably know these guys, actually. They're up there in the Bay Area. Brought into East West Bank. Who had done a lot of real estate collateralized lending, much of which was struggling. And so my role was to clean their balance sheet by selling notes and REO to the extent that there was any. So I did a little over $1 billion of those at the bank. And I like to say I saved the bank. If you speak to the chairman now, he will agree. He is also a good friend and laughs whenever I say that. But anyway, so the bank doubled in size and it was very successful. And I moved on to indirectly through it one step. Oh, actually, another San Francisco player that you would know maybe is Gower Capital, GAW, Goodwin Gore. He buys a lot of San Francisco downtown buildings. But you may know them as Downtown Properties. In any event, it's a Hong Kong Chinese family hired me to run a fund for them. But I was pulled out of that by Colony Capital. So Colony at the time had done when I got there, $6 or $7 billion of deals. Actually, technically, they were in partnership with the FDIC. So these were non-performing loans. Huge portfolios of non-performing loans, and technically it was in partnership with the FDIC. They didn't buy them from the FDIC. And my job was, again, so different from the bank, where I was dealing with individual assets. Because the volume was just so massive at Colony, I repackaged or packaged portfolios of re-performing loans, in some cases non-performing, and sold them to either investors or to banks. It was kind of an interesting time, Bruce, because the market was pulling out of
Right.
its morass or moret, whatever, is down to
Morass. So the morass.
It was beginning, and so banks that had started, banks who had stopped lending during the GFC were totally on defense, playing defense. We're beginning to think we want to start, doing business again. It's time to get back into business. So they were looking for clients. So it was kind of cool because I could go to banks and say to them, look, I've got a portfolio of 20 multifamily loans here for you. Do you want to buy them? And by the way, now you've suddenly got yourself 20 credit borrowers. You can establish relationships. You have to door knock. You can buy these borrowers. So that's what I did for a while at Colony.
Wow.
And then I got into seed and angel invest. So then the economy was pulling out.
Oh, yeah. Then we went into the heyday of funding.
Yeah, it pulled out of the downturn. And so all that fun, distress stuff went away. And I'd actually done exceptionally well during the during the GFC, basically because I'd sold out beforehand. And so I decided to do something a bit different and started to invest in seed and angel investing in startups. Again, San Francisco, you'd know all about that.
Oh yes.
So I used to walk into these meetings. It was really cool, actually, Bruce, because it was a new experience for me. I taught some real estate investment and finance classes at Cal Poly, San Luis Obispo, and the students, they had this little entrepreneurial Center for Innovation Entrepreneurship where the students had these startups.
Right.
They would present them. I was a member of this angel group, and they would present their deals. They wanted us to invest in them. But what was interesting was they were speaking the language of digital marketing. And I didn't know, this was like, could have been Greek for me. I mean, if it was Japanese, I would have understood it. But Greek, I wouldn't have understood. It was totally foreign. But it was intriguing. And around that time, the Jobs Act was passed, the Jumpstart Our Business Startups, 2012. The Obama administration passed a bipartisan bill called the Jobs Act. And what the Jobs Act did was it allowed for general solicitation. And so what that means is that if you are a sponsor or a developer raising capital for your deal, so you go out, you get a loan, but you also, if you got a $20 million deal, you probably need 6-7 million of equity. Right. So you need investors. So what the Jobs Act of 2012 did was it made it legal for the first time since the Securities Act of 1933 to raise money from the general public without doing an IPO. In other words, they allowed for advertising. Well, that had never been allowed. And so the industry simply had no expertise, no even awareness of the possibility of doing that kind of marketing. Right? How do we find investors? That you join a country club, or you'd go to you'd be a philanthropist and you'd donate money, and you'd be
family offices, all that stuff.
Family offices, but you'd have to network in person.
Mm-hmm.
So what the Jobs Act did was it allowed you to actually now advertise. So that means you really need. So it changes everything. And it means that you really now have to have a sophisticated online presence to be able to attract, nurture, and convert prospects into investing with you. And so it occurred to me that all this language of digital marketing was novel to the industry, but it was something I was learning. And I saw an intersection and the opportunity to bring digital marketing into the industry for capital formation. So I set up Gower Crowd, that's the name of my company. Right. And what we do is we build sophisticated digital and content marketing systems for developers or for sponsors. We can define that term in a minute, but whatever you like. But anyway, professional real estate investors, people that go out and buy deals and finance them and whatever, sell, improve and sell them. Right. So we build systems for them so that they can find high net worth investors at scale. Wow. Nationwide. And our clients manage or handle about probably 35 billion or so of AUM. And they've raised, I got to be careful with this number because you can't exaggerate these things. I'll just be, I'll see why my own and tell you that it is they probably raised close to $1 billion
Wow.
with $25,000 minimums. So that's in however long that was, my story, however many minutes. Yeah.
Yeah. Oh, okay. Well, that was well, maybe
6 or
like
7
11
minutes or
minutes,
something.
but that was great. So you're still there. You still got Gow Crowd.
Gower Crowd, yeah.
Yeah, and that's your main point of focus right now. So I want to go back just 1 second here and
Sure.
ask you, in 2008, did you see the great fall at that time? And you sold out previous to that. So did
I
you see
did.
it coming?
Yeah, it's interesting
Yeah.
because
Okay. All right.
I'm not quite as I wasn't quite as scientific as the guys in The Big Short, that kind of analyzed everything and really got under the hood.
Yeah. Right.
My experience was
Yeah.
slightly different. What troubled me in 2007 were, I can only say, it was anecdotal concerns that I had. My evidence is anecdotal. So I'll give you some examples. I was working on one deal. It was an infill, ground up development, single family development for sale in central Los Angeles. And
Okay. Yeah.
it was called a small lot subdivision. It was really interesting. It was new ordinance. It was totally novel. And I was building this particular development, was the biggest of its kind yet in the
Wow.
city of LA. And I was talking to banks to get, I'd raised the capital for it. So I had all the equity that I needed. And I was working with the banks with my plans and drawings and whatever, everything I had to try and get finance, right, to get the debt. And what was odd to me was people that I was dealing with. There was this one woman I was dealing with at one bank who suddenly disappeared.
Oh,
And it just made me, and then she popped up at another bank, but it was just and that's not unusual, but
Right.
there was something about it that just seemed, it was odd to me. And at the same time, you had there were all the subprime loans that were going bad, and that was the big
right.
news.
Right. Yeah.
But simultaneously, the Alt-A's were also beginning to default. And I just thought, this is beginning to cascade. There's weird things going on in banking. It wasn't just this one gal, but there were other things that made me feel something not quite right here.
Yeah.
And then the Alt-8s started to go. And I was literally, Bruce, I was literally waking up in the middle of the night with angst, suffering angst, like angst.
Oh, God.
And so I decided, I'm getting out of this. I'm going to sell. And so I just, this was the first time I actively, it was so important to me to have a successful sale. By the way, I'm going to apologize in advance for saying this, because I know that you and your audience are brokers. So, but by the way, I'm also a licensed broker. So I've got now, I don't know.
I can see this coming. Okay.
At least a billion or so of sales under my belt. I don't know what it is. It's not so much. I mean, some very big guys out there, but
Right.
but at that time, it was too important for me to get out that I didn't want to leave it to somebody else.
Right.
I wanted to do it myself. And at the time, I didn't have a license, but it didn't matter because it was my property. So
Yeah,
I was selling my
yeah.
own stuff. And so I went on the hunt for institutional investors who were investing in similar projects. And I actually didn't. So my approach, not sure how we got here. You're asking something. So I'm going off on a tangent. But anyway, I'll tell you. But my approach was, I know they're going to want to buy this thing when they learn about it. But if I try and sell it, they'll play hardball.
Oh, yeah.
So instead,
Right.
what I'll try and do
Wanted them to come to you.
is JV with them. So I contacted them and say, "You guys want to JV on this thing with me? It's fully entitled. It's like the permits are going through. I've got a GMP. Well, like we're ready to go on this thing. But would you guys like to join me and enjoy the winnings?"
Yeah.
And they said, "Not really, but we'd like to buy it." And I said, "Well, I'm not sure if I want to do that."
Wow.
So that's how I got out of that deal. Yeah. So you asked me about what were the signals. So those are the signals. But I went.
Okay. So let's jump to the signals today, because I think the signals today are somewhat similar to 2008. well, I mean, you've got a lot of REO stuff going on, and people are selling for discounted prices and all those kind of things. So what do you think the future is going to bring us here?
Okay, so I'm going to tell you exactly what the future is going to bring you. I'm going to predict that very, very precisely, but not in the way that you want me to. But before I do that, you've talked about seeing REO and distress coming to the market. What are you seeing, actually, Bruce? Let me take the opportunity to ask this back on you.
Well, mostly what I'm seeing is that properties like, for instance, in San Mateo, there was a property that sold for 75 million a few years ago, and recently it sold for like 25 million. So I'm seeing a fair amount of that and a lot of that kind of discounting going on in San Francisco. So there's a lot of properties being bought for very low prices, cash buyer, cash is king. So that seems to be happening quite a lot.
Got it. Right, predicting the future. So, again, I'm going to tell you exactly what's going to happen, but like I said, not in the way that you want me to.
Okay.
So, I have a PhD actually in banking history, and I looked at how banks mitigate risk. It's a whole different story, a whole different topic. But I like research, and I like looking at history to understand what kind of patterns there are, what kind of trends there are. And I am reasonably sure. Well, I have some serious doubts about where the economy is headed, but with some provisos. But the question is not really, is there going to be a downturn? Is there not going to be a downturn? But more importantly, the question should be, well, if there is a downturn, how do we prepare for that now? Right? So you're going to have half the country is going to say, what's coming out of Washington is going to crash the economy. And the other half of the country is saying we're going to have, it's going to be bliss, joy, and peace on earth. Right, and everyone's going to get super wealthy, and we're all going to be happy and live happily ever after. Right, so you've got this kind of bifurcation of opinions. Either way, it doesn't matter, because if you are an investor or a sponsor, you have to underwrite to worst case scenarios. If you don't underwrite to a worst case scenario, you could lose everything. And there are, if somebody bought for 75 and sold for 25, you can be sure a lot of people lost a lot of money. And they didn't underwrite to, I mean, that's a kind of, obviously an extreme example of value collapse. But you got to underwrite to worst case scenarios. So the worst case scenario for somebody that thinks that we're going to have, years of wonder and financial what do you call
Glory.
it? Economic wonders, right? Whatever.
Yeah.
You still need to keep an eye on what the possibility that there is a possibility that the other people who think that there's gloom and doom and the dollar's going to collapse and the treasury, that 10 years will spike because nobody trusts governance in America anymore, whatever. If that is even a possibility, you have to underwrite to that. Otherwise, you're going to lose everything. You could stand a chance of losing everything. So the answer to your question is like this. Every single major downturn throughout history, from the Great Depression, which was, obviously before our time, but the Great Depression, the savings and loan crisis, which both of you and I went through, the dot-com bust a little bit, that less impacts on real estate, COVID, the GFC, the Great Financial Crisis. All of these downturns are triggered by fundamentally different things. You cannot predict what is going to cause a crash. Cannot do it. But there is a golden thread that weaves its way through all of those downturns. And that golden thread is how the winners win. And there are three key factors to that. This is consistent. I wrote a white paper on this. I looked at the Great Depression just recently, actually, and I wrote a white paper on, okay, so how did the people that really came out of that time, who became incredibly wealthy, on the backside of the Great Depression, how did they do it? What were they doing? And what they were doing is the same as the people were doing in the global financial crisis, same that the people were doing during the S&L. That is the golden thread. They're all doing the same thing. And this is what they do. The first thing, reduce debt. You have to have low debt. Second, cash flow and reserves. And the third key thing, interestingly, and this actually speaks to a lesson that I learned and have already talked about, Bruce, during the global financial crisis, was that banks, when they go to ground during a downturn and then things start pulling back up, they are looking for credit tenants, credit borrowers. They want to lend again. So the third pillar of success is to establish positive relationships with lenders, even during the hard times, even if you lose money. Hilton, right? So this is a really good example. So Conrad Hilton almost lost everything. In fact, he did. He lost everything during the Great Depression to the banks. But he pivoted. The banks didn't know how to run hotels, right? But they had to take them back. So he lost all the chance. So he cut a deal with them and said, look, you take it back, but pay me a fee and I'll run the hotels for you. I actually ran a hotel during the global financial crisis, Bruce, seriously. We took back a hotel. So we were going to foreclose on this thing. And a couple of months before I was thinking, I said to everyone, I said, listen, guys, yeah, we're going to foreclose on this hotel, but it's actually operational. We're going to have to serve muffins and change sheets. Like, how are we going to do that? So it's a big deal for a bank to take back a hotel. So Conrad Hilton pivoted and he became a consultant to the bank. So when the market started turning around, he was perfectly positioned to buy them back at discounts from the banks, which is exactly what he did. And that's how he built his wealth. Another thing, actually, that you've got to look for, actually, is kind of a fourth pillar, if you like.
Yeah.
It's creativity. So the Empire State Building was 30% occupied when the Great Depression hit.
30%.
Something like 30%.
Yeah. Well,
it was known derogatorily as the empty state building, not the Empire State Building. It was kind of joked about. And so what they did, the owners of the Empire State Building, was, you may well have been there actually, is they created an observation deck on the Empire State Building.
Been there. Yeah.
And they charged a fee. Yeah. And the amount of money that they generated from tourists and people wanting to go up and down the elevators and stand on that, in large part, saved the building, saved them from loss on that building. Wow. And even today, it's a major, I think the Rockefeller Center, the Empire State, I mean, these are huge money earners for these buildings. So being creative during a downturn to save, what you have, in addition to these other factors, is very important. So that's my prediction. You don't know what's going to actually hit the market, but you've got to be prepared, and that's how to be prepared.
Oh, all right. As you probably saw, my wife came out of the door here, and so that means it's time to go get the grandchildren. Got it. This has been a fascinating conversation.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.